Hello, everyone. Welcome to this special edition of ICICI Direct's Investonomics. It's our flagship learnings platform wherein we invite thought leaders, business icons, and market experts to come and talk about their experiences and bring insights that help our investors in the financial journey. I'm Anupam Guha. I head one of India's leading wealth management outfits. And the topic of today's discussion, I would say, having personally seen from close quarters for over 2 decades, is really the core of money management, I would say. It's about taking a closer look on why people behave and the way they do when dealing with money. It's on the psychology and what really goes in decision making, both on the rational side and on the irrational, and our own biases while we make our investment decisions. Right. So this topic is actually very relevant in today's hyper, connected world as well, where we get a deluge of data and information. And really, you're being nudged by experts, you have the so-called social media influencers. And really, how do you bring sanity and simplicity in your entire decision-making process and really not follow the herd? Because as we all know, that in personal finance, it's really, always it's more personal than finance. And actually, on that note, let me introduce the guest for today. He's a former columnist at the Motley Fool and the Wall Street Journal, and has been a prolific, in his writing. And actually, that's when I think many of us had started following him for the last maybe 10, 15 years that he's been writing. He has received many awards and accolades in business journalism. But I think what's really making ripples is the impact of his book, The Psychology of Money, which has got sold over 1 million copies and has been translated in 46 languages, right? So a book that gives timeless lessons on wealth, greed, and happiness. In fact, it's my pleasure to welcome Morgan Housel.
Thanks so much for having me. I appreciate it.
So Morgan, really, thank you for joining us, and really thank you for some insightful writing over these years.
Thank you.
So Morgan, let me get going. In India, we are seeing a massive growth in, young investors joining the equity markets. In fact, if you were to look at statistics, it's actually, gone up by almost 6-7-fold in the last couple of years, right? Especially post-pandemic. And also, from a very interesting perspective, you have almost 15 million, new investors or young people really joining the workforce, and they are all getting employed and will have surplus money. So we're really looking at a structural shift where we are seeing young millennials and Gen Z, right, who are digital natives, are getting into the financial markets, right? They're investing into the equities, and for them, luckily, they've only seen the good side of the markets. They've seen the markets go up, and they do not have the experience of going through cycles. So my question to you, Morgan, would be that what would be your advice to investors who are starting the financial journey? And I can only say that we have a large population of them in our audience today as well.
Yeah, I think what's interesting about this is we know, and hopefully the new investors know, that you can make a lot of money in the stock market over a long period of time. That's what history tells us. But it's just like anything else in life. If you want the benefit, if you want something good, there's a price you have to pay. Nothing's free. There's a price for all of that. And the price in investing that you have to be willing to pay is putting up with long periods of decline and loss and uncertainty and havoc and chaos and volatility. That's what you have to be willing to pay. That's the cost of long-term returns. So when you have a period, and it's the same for us in the United States in the last 2 years, where we've had millions of new investors come in for the first time, and all they've really known until the last couple of months at least is a market that went straight up. I remember 6 months ago, someone on Twitter said, if you can't double your money every 6 months, you don't know what you're doing as an investor. And I was like, okay, there's the sign of what people are thinking right now. And so my advice to the new investors would just be to realize that the cost of doing well over time is putting up with periods when the market behaves the opposite of what it has done over the last 2 years. That's what you have to be willing to put up with. And it's not fun. It hurts. A lot of investors are just going to quit when it happens. And that's why doing well over a long period of time is not something that lots of investors achieve. It's not hard to do well over a long period of time, but most investors don't because they don't recognize what the cost of long-term success is. So they're not willing to pay it.
Yeah, fair. Also the other aspect, Morgan, is that, every investor is unique, right? While you hear a lot of information today on social media, which seems to be quite generalistic, so to say, but from an individual perspective, your needs, your want, your aspirations are quite unique, and some of it is really linked to maybe your risk appetite as well, your need for liquidity, and so on and so forth. And when investors take decision, right, you have two spectrums of it. On one side, you really have euphoria of the markets, and on the other side, you have really the fear of the volatility. And those are really, kind of giving you nudges in terms of how you behave in the market. So in all of those, in all of this, right, how do you really bring discipline and structure in terms of money management?
It's really hard because you're right that, look, what you have experienced in your lifetime in India is very different from what I've experienced in the United States. We've had different recessions, different political climates, different growth. Our future growth prospects are much different. So your view of the economy is very different from mine. And it's not because you or I are smarter than one another. It's not because we have different information. It's just because we happen to have been born in a different country. It's not our fault whatsoever. And that's true for everybody. People who live in the United States or Europe or Australia or Japan or India think different things about the stock market. That's been documented. It's really clear that people are just a product of where they happen to have been born. The generation that they were born into and where they were born is how they view the world. And we all view it very differently. When you accept that, then you realize that there are very few universal truths of investing, of economics. Because what I think is true about the economy is influenced by the fact that I am a male in my 30s in the United States. That's the view of the world that I have. And that's true for everyone. And I think the practical takeaway from that for finance and investing is that when you realize that everyone has a different view of the world, you realize that everyone's risk tolerance is going to be different. Everyone's ability to endure loss is going to be different. Everyone's personalities are different. Their ages, their family situations are all different. And therefore, there is not one right answer for what you should do as an investor. And what is right for me, for my personality and my age, might be very different from yours. And again, it's not because we disagree with each other. It's not because one of us is smarter than the other. It's just we're just different people. So I think once you accept that, then what you do as an investor and in personal finance is just become more introspective about who you are and what your goals are, what your risk tolerance is, and accept that it might be different from mine. And it might be different from your neighbors, and it might be different from your colleagues. And that's fine. You guys don't disagree with each other per se. You're just accepting that everyone is different. I think that's probably the single most overlooked part of all of finance and investing, is that there's not one right answer for everybody.
Yeah, well said. When we look at investing, and I think there is a lot of emphasis on long-term thinking, long-term investing. And we all know that we shouldn't really disturb the power of compounding. We should allow it to really grow for long periods of time. But when I put it in context of what's really happening in the financial world, you have, say, a metaverse falling by 20% on one day. You have the tech ETFs falling 30-40%. I mean, investors would really question some of those classical philosophies. And then should one look at long term as a series of short term? I mean, what's your view?
That's always it. It's one thing to say, I'm a long-term investor. I'm investing for the next 10 years. That's easy to say, but you realize that the next 10 years is just a series of short terms. It's a series of days and weeks and months that you have to put up with and endure. And so when you say I'm investing for the next 10 years, that does not absolve you of having to put up with and experience and witness short-term volatility. And I think that's a big disconnect. And that's why it's easier to say I'm a long-term investor than it is to actually do it. I've used the example before, but it's like saying you're a long-term investor is like standing at the base of Mount Everest and saying, I'm going to the top. And you're like, okay, that's great. That's a good goal. But now comes the hard part. You actually have to get there now. And that's the hard part of doing it. So being a long-term investor is the right mindset. but you have to realize that that means managing short-term news cycles and volatilities and emotions, just like any other short-term investor. And look, when you've had these periods, like you've seen with tech stocks, where some of these stocks will lose a third of their value in a day and have lost 75% of their value in the last year, that's extreme. Like that's not, if you're looking at like a market index, that's not the kind of thing that should happen outside of the Great Depression, let's say. But for a lot of those companies, the question is not why have they declined 75%? It's why did they go up fivefold to begin with that set up the 75% decline? You got to answer that question too. But you're absolutely right that the long term is a series of short runs. And therefore, as an investor, you need to figure out how to manage your news cycle, the information that you are taking in. You need to figure out how often you're checking your portfolio in a way that's going to prevent you from making rash decisions. You need, like, those are all short-term things that long-term investors need to figure out. Otherwise, they're going to think philosophically that they're long-term, but they're still just going to get caught up in whatever's happening over the next, week or month.
Yeah. I would maybe want to touch upon, diversification. While you spoke about, the extremes of some of the tech stocks, going down by 70%, and which is where you spoke about maybe the ETF, which is a diversified portfolio. We all know that, some investments would do well and some wouldn't, right? And that's, I think, very common and very similar to how it's in business or in life in general as well. And, there are those vagaries of the economy and the market that you may not be able to predict. So from a portfolio building perspective, Morgan, I want you to maybe talk a little bit in terms of the role of risk and luck. And also, I think you also have mentioned that, you can be wrong half the time, but still make a fortune. So your comments on this.
I mean, if you look at a long period of time, and let's say you're looking at 1,000 stocks, the whole index, let's say, the majority of the returns from the index are probably going to come from 20 stocks that were mega successes. They were the Amazons and Apples and Microsofts and Facebooks that drove all of the index's returns. So from an investor, if you're looking at the next 30 years, really all that matters is that you own the next 20 companies that are going to change the world. And the other companies that you might lose all of your money on don't really make that much of a difference, because you're going to make up all of your money on the couple of winners that you have. And therefore, from a portfolio construction perspective, really what matters more than anything is ensuring that you own the 20 or so companies that are going to change the world. And if you don't, it's going to be really hard to beat the market. And if you do, you're going to match the market, even if the other 800 stocks that you own go out of business. That's kind of like the tail-driven world of how investing works. And therefore, when you own an index fund, you're guaranteeing that you're going to own the 20 stocks that are going to change the world over the next 20 years. You're going to. You have everything. You're going to do it. Whereas if you're a stock picker, you better be darn sure that you do, because if you don't, it's going to be impossible to even match the index. That's just how the distribution of the returns work. That to me is just putting the odds of success in your favor. Like, there's no sure things in investing. There's no, I know this is right, I know this is wrong. Everything is just based off of the odds and probability. So I think if you own an index, then you are increasing the odds, you're increasing the success, the odds of success that you're going to own the couple of companies that change the world. And if you're a stock picker, like, you might be increasing the odds if you have confidence in yourself that you can only own those 20 stocks and none of the losers. That's one thing, but that's very difficult to do, which is why the evidence that we have points to that. I'm not against stock picking at all. I think stock picking can be a great thing, and there are talented, smart investors out there who can do a good job at it and will beat the market over a long period of time and earn their fees. Totally. I absolutely believe in that. But I think for a lot of investors, if you think about the simple math and what is like the hands-off approach to achieving it, I think index funds can be a great way to go.
Yeah. One other interesting topic that I want to maybe discuss is really about savings, and the need for it. In fact, in India, the entire baby boomers generation and the early Gen X, I think they lived below what I think, they could afford. And they really created a corpus, and corpus just not for their immediate goals, but really for a rainy day. While today, the trend that I see in India is a lot of consumption and credit. I mean, do you see similar trends in US as well? And would you want to talk a little bit about, the entire concept of savings, or saving the money for the long haul?
It's a little bit different in the United States because we had a giant credit boom in the early 2000s that ended with the financial crisis of 2008. And since then, since 2008, the last 14 years now, Americans have kind of been reducing the amount of credit that they have relative to their income, at least. And if you look at, because interest rates are so low, the amount of debt payments relative to income that we have in the United States is the lowest it's ever been. So Americans are in pretty good shape financially just because we had our party, we had our binge 15 years ago. On the topic of savings, though, and on savings in the United States, that's near a record as well because we had so much stimulus payments during the pandemic. Everyone got checks in the mail from the government, and most of that money was saved. So U.S. consumers are in great shape. In terms of the philosophies of savings, the thing that's always struck me is that most people think that they need a reason to save. They think that, oh, I'm going to save for a new car or a new house. And it's a very specific thing that they're saving for that they can see that they know they're going to purchase. And that's great. That's a great thing to do. But all of the world, all the big economic events in the world are surprises. They're things that nobody saw coming. It's either like a pandemic that no one saw coming or a terrorist attack that no one saw coming. All these big events that you could not predict, that's what moves the needle. And at the individual level, it's losing your job in a way that you did not expect, a medical emergency that you never expected, all these things that you can't foresee. And because of that, I think it's appropriate and right to save money for risks that you cannot envision and just save money because you know that the future is going to be surprising. It's not for anything in particular. You don't know what it's going to be, but you're just saving for whatever is going to happen in the future. That's the right way to do it. And the way to think about this is that if you're only preparing for risks that you can envision, you're always going to miss 10 times out of 10. You're going to miss the surprise that does way more damage than any other of the other risks that you could envision. So you always, the right way to do it, the right mindset is you always want to feel like you have a little bit too much cash. If you have a little bit too much cash, that's when you know that you have some cash for the surprises that you cannot even envision. If it feels like you have the right amount of cash, then when there's a surprise, all of a sudden it's not enough cash. I think that's the right mindset to have, is you should always have just a little bit of discomfort in the amount of cash that you have.
No, I think very well, very insightful, Morgan. I mean, because I think most of the times people tend to underrate, cash in the account, because as you rightly said that it's really, the big upside that you would miss if you do not have that cash. People don't tend to see that perspective. So great perspective. Yeah. Moving on, I mean, are there lessons from history, I mean, in terms of investing that you may want to share?
I think the biggest lesson from history, from investing, is just how prominent and prevalent and common volatility is. And it is so often that whenever there's a 20% decline in the stock market, that even among professional investors, they want to explain like how the market's broken, how this is a bad time to invest. Where if you look at the long history of the stock market, a 20% decline is just run of the mill that happens on a regular basis, and it does not prevent long-term returns. That's the biggest difficulty is, and the biggest lesson from history is how common it is to associate a 20% decline, as an example, with a broken market, when it's actually just like, it would be like if you live in a really nice tropical place and it rains one day. You would not say the climate's broken forever. You would not say like, this is not a great place to live anymore. It's like, oh, it's raining today. Sometimes that happens. It'll probably be sunny tomorrow. And that's just how it works. And that's really hard to wrap your head around, especially in real time. For me, even too. I mean, if you go back to March of 2020, when COVID first hit, I was really worried about the global economy. And I had talks with the smartest friends that I know who said this was going to be worse than the Great Depression. And there was a chance that that's what would have happened. Just because it didn't happen, there's a chance that it really could have. And in that moment, it was scary. So it's easier to say, oh, I'm totally fine with a 20% decline. I'm totally fine with a 50% decline. But then when it actually happens in the context of whatever is happening to the world, like a pandemic, then it feels different. It's easier to say I'm going to be greedy when others are fearful, to quote Warren Buffett, than it is to actually do it. And so that's why living through some of these events in real time and having a little bit of investing experience to know how it feels when it happens is so important. And I think most people, not everyone, but most people have a lower risk tolerance than they think, than they expect, than they want. And particularly during a bull market like we have right now, it's easy to think that you have a high risk tolerance. But then when something like some big economic surprise happens, you realize it's a little bit lower than you think. That's another lesson from history.
Fair statement. Morgan, so I'll move ahead. I mean, I've been practicing money management for our clients for over 2 decades, and whenever I have met clients, they've surprised me with the amount of wisdom that they have in terms of how they've managed their money, their businesses in terms of the growth. And, there is a very subtle difference between, being wealthy to getting rich. And, also for people who become wealthy, I think, there's a structure that they put in place to ensure that they preserve the wealth. So maybe you may want to talk a little bit about these concepts and your thoughts on it.
My idea has always been wealth is what you don't see. Wealth is what you have not spent. Wealth is the money that you have earned but chose not to spend. And rich, if you want to call that, is money that you've earned and have spent on nice stuff, on nice things. And those are very different components. Because since wealth is what you don't see, wealth is the money you have not spent. It's money that it's in the bank or is in your brokerage account you haven't spent. It's hard for everyone else to view other people in society and learn about it. Because I can see the cars people drive and the homes that they buy, but I can't see their bank account. I can't see their brokerage account. So you really have no idea actually how wealthy people are, because wealth by definition is hidden from view. And so I think a lot of people go through life with a false sense of how successful other people are. And they look at someone driving the nice car and assume they're very wealthy. And they look at the person driving the cheap car and assume they're not. And sometimes that's true, but a lot of times it's not true, because wealth is what you don't see. So then the question is, well, if wealth is what I don't spend, what's the purpose of it? But having independence, I think, is a much higher correlate with happiness over time that is easy to ignore, and it's invisible from view because you can't see what other people have in the bank.
Yeah. Morgan, as you're aware, we are live on our social handle, Twitter, Facebook, etc. And I actually am also getting a few questions. So I'm going to actually take a few questions from here on. And one of it is, why has behavioral finance become more popular over the last maybe decade or so?
I think there was a period over the last 100 years where the big improvements in finance, the big innovations, were on the analytical side. Like 100 years ago, we didn't know how to value stocks properly. We didn't understand discounted cash flows. That just wasn't part of society's knowledge back then. We made a lot of improvements over the last 100 years on the analytical side. We also got much more data than we ever had before. 100 years ago, public companies really didn't release that much information about how they were doing. And so not only do we have more data than ever before, but we spent a lot of progress. There's a lot of innovation on how to interpret that data. And so we got to a point probably in the early 2000s where I feel like the broad consensus was that we have solved finance. We figured it out. People are winning Nobel Prizes. We got the physicists at Goldman Sachs. Like, we figured out finance. That was the view. And then after 2008, after the financial crisis, everything imploded and people lost huge sums of money. And it was clear that the idea that we had solved finance was not true. We've made a lot of strides on the analytical side with the formulas and the data, but the idea that meant that we were perfect now was so far from accurate. And I think that just opened up this window that there's another side of investing in finance outside of the data and the formulas, which is the behavior. And if you don't get the behavior right, if you don't control your propensity towards greed and fear, then none of the analytics necessarily matter. Because you can be the smartest finance PhD from MIT, working at Goldman Sachs, know everything, all the finance formulas, have all the data. But if you panic in 2008 or in 2020, none of it matters. None of the formulas, none of the data matters. And I think that's why behavioral finance has a new spotlight on it. It's just because it became so clear that as proud of ourselves as we were in the early 2000s for fixing and solving finance, it's clear that without the behavioral component, none of that matters.
Yeah. I'll take one more question, Morgan. And this is really about, it says that what is one thing that one should not do instead of what one should do in terms of money management?
So that's a great question, because the huge majority of investing success is what you don't do. So what shouldn't you do? It's going to be a different answer for everyone. But I would say in general, what you should not do is wake up and read the news and change your portfolio based off of what you saw in the news, which is a lot of what people do on a daily basis. And there's just no evidence that individual investors can do that accurately. Read news headlines about corporate earnings or where the economy is going to go or how many times interest rates are going to increase and make a tweak to their portfolio in a way that is profitable over a long period of time. That's what I think people should not do. Now, I love reading financial news. I read the newspapers every day. I read the headlines. I'm on Twitter all day, of course. But I don't take actions with it. I love reading it because I think it's interesting. I think markets are interesting. I think the economy is interesting. But I don't read that and take those learnings and then go change my portfolio every day. That's, I think, the biggest thing to avoid.
Yeah. And also, I mean, what part of the book, you would say that has been most relevant to your own life?
I think there's two parts that stick out. One is the idea that people are not machines. They're not spreadsheets. So therefore, we should not expect people to be perfectly rational all the time. Everyone wants to think, oh, I want to make rational decisions. And that's a good template. But the fact is, we're not rational people. So the best that we can do is not to be rational. It's just to be reasonable. If you could just make reasonable financial decisions that sometimes aren't perfectly rational, but they fit your personality, they fit where you are in life, they fit your family's goals, they kind of scratch an itch that you have for wanting to be entertained or whatever it is about your personality, that's the best people can do. And that can be really great over time. If you can be reasonable for your entire life, you'll do great financially, even if you're not always being perfectly rational. That's one. The second point is kind of what we talked about earlier about how everyone is different and there's no one right answer. And I think that's the basis of most financial debates, is that two people who have different risk tolerances, different goals, they're from a different generation or a different country, they think they're debating one another, but they're not. They're just talking over each other because they have different goals. And I think once you accept that, then 90% of the debates and arguments in finance and investing, you realize just aren't very productive, aren't very relevant, because everyone's different. So of course, people have different views and different goals and different strategies about how to invest.
Yeah. One other question, is there something that, you've changed your mind of late of what you've, because while you've written this book, I think in 2018 also, you had kind of taken out a note around psychology of money. And I think you've been, kind of writing on this subject for almost a decade. And over a period of such a long time, I'm sure, thoughts would have got more distilled. You would have got new perspectives. So is there something that, you've changed or from where you started to where you are today?
I think there's a few things. One, the biggest is just the idea, again, that everyone's different. I think 10 years ago, I was more aligned to the idea that there was one right answer that we should all try to find and follow. And now I just realized that's not the case. The other thing is the difference in people's life stages. So I have two young children. Before I had those two young children, I thought very different about my future goals. And once I had kids, everything changes. And the big takeaway from that too is that there are, like, Morgan in 10 years from now is going to be very different from Morgan today, because Morgan today is very different than he was 10 years ago. So people really underestimate how much they're going to change in the future. And it's easy to see how much you've changed in the past, but then to take the next leap and say, I'm going to be a different person in the future is really tough too. So just being more empathetic to people when they change their views, including when I myself change my views, has been really important. I've also changed my view, I think, on early retirement, on the FIRE movement, in that was always my goal, was to retire early. So I thought I wanted to spend my life just like sitting on the couch and reading books and hanging out with my friends. And I realized, and a lot of people in the FIRE movement have realized this, that can actually be a pretty depressing existence if you don't do it right. that for most people, work gives them a certain amount of structure and purpose and identity in the world, that if they abandon it, they're kind of lost. So rather than financially independent, retire early, I want to be financially independent, but I still want to work every day for a very long period of time. That's something else I've changed my personal views on.
Right. Morgan, two last questions from my side. One is, from a global trend perspective, especially post-pandemic, how are you seeing things?
I think if you had looked over the last 2 years, there's never been a 6-month period where anyone really got it right what was going to happen, both from the virus perspective and the economic perspective. I just think it calls for so much humility in where we are. One thing I would say, though, is that if you took the 10 most likely outcomes, the 10 most likely economic outcomes of COVID-19, we ended up with the best worldwide. That's not to say that it hasn't been devastating for billions of people financially. But if you look at what should have happened or what could have happened, I think we ended up with the best outcome. I think that's probably also true for 2008, by the way. And one takeaway from that is, like, we might be lulled into a sense of complacency of, oh, even when there's a massive global shock, we still end up okay. That's not always the case historically. I think policymakers around the world, by and large, did a really good job over the last 2 years. Not perfect, but a really good job. And there's a long history of policymakers not doing a really good job. So I think if there's one risk, it's that we get a little bit too complacent with how good we are at managing crises. And then during the next crises, whenever it is, whatever causes it, we're resting on our laurels a little bit. We're not prepared as much as we should, because we have this idea that the Federal Reserve and the Treasury and central banks around the world will just come in and bail everyone out. And there's probably going to be a time in the future when that is not the case, to the extent that it has been over the last 2 years.
Right. So Morgan, one last final question from my end, and this is really because I love reading the book, written very it brought in a lot of clarity and has been written with a lot of simplicity. If you were to summarize your learnings, right, what would be the top 3 key takeaways for our audience?
I would say people are very messy and confusing. And we should just embrace that. I would say that investing is simple, but it's not easy. I would say that there's a lot that we can learn from history that we ignore, that is right there to look at. And history always changes, but people don't. Like, the historical events will never repeat themselves, but people's behaviors will always be the same. It's just part of who we are and what we've evolved to do and how we've evolved to think. Those are the biggest takeaways from the book. But the book is designed to be 19 very separate, distinct takeaways rather than one theme throughout. But if there's an underlying theme that connects them all, it's that.
Also, thank you so much, Morgan, for writing such an insightful book, for all your writing over decades, and really coming on our show and really sharing your thoughts. I wish you all the very best, and I hope that more people really read this wonderful book that's been written with such clarity on topic that I believe is evergreen. So thank you so much, Morgan, and all the best.
Thanks so much. I appreciate it.
Thank you.